Good afternoon. This is going to be my supplementary presentation for my informational report on short selling stocks. My name is Jonathan Farrell, and let's get going. So, what is short selling? Well, to put it simply, the act of short selling is taking selling a stock that you don't necessarily own at the moment via borrowing or just selling a stock that you don't own, and then purchasing it at a later point, typically at a lower price than the sold price, and then selling that at the negotiated price. Usually, this is occurring with brokers or even individuals. Large companies do this on a daily basis, and it's typically a pretty fast turnaround. Like I said, the primary organizations that are doing this are hedge funds, stock brokerages, individual stock traders, something that I look forward to getting into as a side project. So a lot of the stocks that are being traded in this, basically anything can be traded in this fashion, but the primary ones are biotechnologies, video game companies, pharmaceutical companies. All of these based off of the volatility of their, or like the cutting edge of their product, can either tank a stock, which creates a profitable environment for short sellers, or increase, which if they already hold stocks also increases profitability. So just the volatility of these different markets is why this is such a huge part of the industry. Some of the pros and cons, like I said, higher profit potential. You're turning stocks like these over very short periods of time. Traditional stock trading, you buy a stock and you wait and you hold it and you wait for the increase to avoid the taxes or short selling. There is a fee that comes with short selling, so by holding stocks with a traditional trading technique, you're avoiding these things, but also reaping dividends based off of that. So with short selling, you have very little research on the long-term effects of it. It's more of like a day-to-day basis. Very little capital injection because of the fact that you are borrowing or selling before you own. So you don't need as much initial investment. Some of the cons, though, is that it's very easy to overextend. You could potentially borrow a lot of stock and then not be able to sell it, and then sell it back to the person for a loss. You're not getting any kind of passive income with dividends, and you are making a smaller profit amount per transaction. So you have to do a lot of transactions to actually make a decent amount of money doing this. On the grand scheme, obviously, there's outliers. How are these affecting the market? Well, the consensus, there is no consensus in by economists on this exact effects, but one thing they do agree on is that this causes a very volatile market, in whichever stocks are seeing a lot of trading within, which isn't always a bad thing, but more often than not is. It does cause companies' value to inflate, giving an incorrect value of the company. So when actions are made for or against the company, that number being inflated is usually a bad thing and causes a crash for that company in the long term. GameStop in 2020, a lot of Reddit users were buying GameStop stocks, and caused the company to be overinflated and overvalued. And then when they decided to split their stocks, it basically pulled the rug out from all the people who actually owned them before the Reddit. So, it's overall still a lot to be understood with the way that technology is working now. That there are stocks being traded that human beings don't even see necessarily. It's just computer programs and clicking buttons. So there's going to be more studies based out coming in the next 10 years probably, but we'll see the exact effects. Here are my references. There's not a lot of in-depth studies on specifically short selling, but more of uh, the ancillary effects and causations of it. So that's my presentation. Have a good one.